Welcome back to our channel Investment Ventures. Today we have an educational video for you, and this is about the different types of mutual funds: closed-ended mutual fund, open-ended mutual fund, what is an ETF. If you do like our videos, follow us on Telegram, Facebook, or on YouTube. So let's see what are the different types of mutual funds. And the reason I am doing this video is because I do get pinged and I do have questions from a lot of my known folks about where should we invest, what is an open-ended fund versus a closed-ended fund, what is an ETF, how does it differ. So first let's look at what are the different types of funds in the market. So first one we have is a closed-ended mutual fund. Now what is a closed-ended mutual fund? When you have a fund house that comes out with a new fund offer for a limited period of time, and they, let's say, have announced a theme around where they will invest, whether it's a large cap, whether it's a mid cap, but the fund offering is only for a limited amount of time. After that, no further funds will be accepted into that mutual fund. This will also be listed on the market. So that's what they call as an close-ended mutual fund. Now, in comparison, let's look at an open-ended mutual fund. Same thing. You have a fund offering. It's open during that time. They do mention the theme or which stocks they will invest in, what type or category of stocks will they invest in, and then they close that fund for a certain amount of period where they will invest all that money, and then post that period, the fund is open again throughout for any transactions. Probably someone wants to exit, someone wants to invest additionally, a new investor wants to invest in that fund. The fund is open for transactions again at the prevailing net asset value. The third type, which we have here, is an interval fund, and now this is not really very popular at this point. The only difference between an open and interval fund is once an open-ended fund is open for business, it is open throughout. Unlike an interval fund, it opens and closes during a certain window. So let's say it's open for transactions only during the first week of the month. And then there are no further transactions, no new additions, no new sales that can be executed unless the window is again open in the next month, first week. So that's what you call an interval fund. And that's the reason it's not very popular, because it doesn't give you easy entry and exit. And the fourth type of funds, which has also gained a lot of popularity in India and also in the US, is exchange traded funds. In fact, exchange traded funds are popular worldwide. Now, the benefit of an exchange traded fund is it closely tracks an index, or it invests in securities related to a particular theme or an index. The stocks are predefined at the time of the fund offer. After that, it is traded on the index or on the market. So it will closely track its NAV, it will closely track the benchmark, easy transaction ability, and low cost ratios. So this is the most popular type of mutual fund, I would say, as on date. Let's see what we will evaluate these funds based on. One is the timing of the offer, the type of management, whether the fund will be actively managed, passively managed, how easy is it to transact in these funds, what are the different types of charges that get levied, and is it worth investing in these funds. And because even a small expense ratio can really eat up into your profits if it's a recurring charge. And lastly, what is the expense ratio? Okay, so I've put up a comparison table here. Now, if I look at it one by one, a close-ended fund is open during the NFO period only, new fund offer period only. An open-ended fund is open during the NFO, shuts down post the NFO for a very short window, let's say because they want to deploy the funds. After that, it is open throughout. An interval fund, similar to an open-ended fund, opens through the NFO, money is deployed, and then it opens and closes during intervals. So let's, like I said, first week of the month. An ETF is generally open during the NFO, but they do have the ability to attract new money and accept new money from large investors on a private basis, or if they want to increase the size of the fund, because the units will be limited once the NFO is open. And let's say they have collected 1,000 crores and it is tracking the Nifty or it's tracking the Bank Nifty, then it will closely track only that, and those funds on the units can be traded on the market. But if, let's say, a large investor wants to invest in that basket of securities, then they can have a separate discussion with the mutual fund house to increase the units and as well as invest it on their behalf. Or if the mutual fund house feels that they want to increase the number of units on the market, they can invest in it and then sell these on the market. In terms of managing these funds, close-ended funds are usually actively managed. They hold a basket of stocks which is at the discretion of the fund manager or the theme that has been published in the beginning. And you can, it depends upon the fund manager's performance. You could actually exceed the benchmark or you could fall below the benchmark. So it depends on his acumen and performance. Open-ended fund, again, similarly actively managed, holds a basket of stocks, and the performance depends on the fund manager's capability. Interval fund is also similar to an open-ended fund. Totally depends upon the fund manager and his acumen of picking stocks, and he can either track or exceed the benchmark or fall behind the benchmark. An ETF, on the contrary, is a passively managed fund. So once the stocks have been bought and selected, the ETF closely just does not invest any additional funds unless there's a change in the index or the funds that it is tracking. So let's say if it's tracking the Bank Nifty, and currently ICICI Bank has a 10% weightage, and because of certain changes the weightage goes down to 5% and HDFC Bank's weightage goes up to, let's say, 20%, then those adjustments are made in the ETF. But besides that, there's no other change that happens in the stocks that are selected. So it's a passively managed fund. And a person is well aware of what it invests in because those stocks and all are listed out right in the beginning. A close-ended fund, now let's say what is the transactional ability and the liquidity that you can get. Close-ended funds are traded on the market, so you have an easy entry and exit. All you do is just have a demat account. The stock is in your demat account. Once you trade it, it is taken out of your demat account, and you will be entitled to the funds at the rate at which you have sold it. Open-ended and interval funds both can be bought and sold only via the mutual fund house. So you need to raise a request for it, let them know that you want to sell it or you want to buy additional units, and then they will buy and sell. And there could be some charges that they might levy, but you can only buy and sell through the mutual fund house. ETF is similar to a close-ended fund. It is traded on the market. Easy entry exit. All you have to do is just place your orders through your broker and it will be traded. What are the different types of charges that are levied? So for a close-ended fund, you might end up paying brokerage charges. Plus, the AMC usually charges some fees to actively manage the funds. So they might be having, let's say, a 2% charge annually or a 1.5% charge. Whatever the charges are, that's the AMC charges that's levied depending quarterly or half yearly or yearly, and then the brokerage that you will pay your broker for transacting on that fund. Open-ended and interval funds are very similar. They may or may not have an entry exit criteria and entry exit charge, plus AMC charges that the mutual fund charges to manage your funds. So let's say they have no entry charges. They might have zero entry charges, but they might say that if you exit within 6 months, then you have to pay a 1% penalty charge. That's your exit charge. But if you exit after 6 months, there's no charge. Those are also the things that they can come out with just to make it more attractive. ETF is similar to a closed-ended fund. You only pay brokerage charges and you pay AMC charges. In terms of expense ratio, a closed-ended fund and an ETF have low expense ratios, so they offer you maximum bang for your buck. Usually open-ended and interval charges, if they are levying entry exit charges, which they usually do, then the expense ratio turns out to be high because you end up paying AMC charges, which you will pay any which ways across all the funds, plus you pay an entry exit charge. In terms of ETF, it also depends. If your brokerage charge is very high, then you have an exit charge which is high, you have an entry charge which is high. But if you're working with a discounted broker, then your entry exit is really immaterial. If it's a large transaction, you might end up paying only 20 rupees on a whole transaction, just to give an example. Now, ideally, we prefer investments through ETF, but mainly because if you are aware of a theme, let's say there's an ETF tracking life sciences or an ETF tracking consumer staples, the stocks are pre-decided. You know the stocks that the fund will invest in. So uh, instead of selecting, so let's say when during COVID times, consumer staples were the best performing sector in the beginning, and at that point of time, you didn't want to pick a single stock like a Hindustan Lever or a Dabur. You wanted to pick the basket of stocks. Then you rather go with the thematic ETF fund because you know that they are investing in the consumer staples stocks. The list of stocks is known to you. It will closely track the fund. The fund will closely track the stocks that it has invested in, and that's an easy bet. You're not taking any stock specific risk in that case. You're taking a sector specific risk. So we generally prefer ETFs. Close-ended mutual funds do offer some advantage at times when the fund does not track its NAV. So let's say if the NAV is higher and the fund is trading at a discount on the stock exchange, then you might want to invest in the close-ended mutual fund because you're getting value for your money right away. So that's another time where you can consider investing in close-ended mutual fund. Now, lastly, having said all this, there's another category which I personally like and I do invest in, and that's a totally different route. It's not a mutual fund. It's a company. It's investment companies, for example, let's say holding companies like Tata Investments or Godrej, then Kalyani Investments. These big corporate houses have their companies through which they invest in their own companies or in the market through those holding companies. Those are also good investment vehicles because many a times stocks trade at a discount to the NAV. And if you liked, we have another video on Tata Investment, and you can watch that to understand more how that company operates and what does it do. It operates very similar to a mutual fund, so it'll be good if you can watch that video. That's it for today. If you do like our videos, follow us on Telegram, Facebook, YouTube channel. We do have our brokerage company. We are franchisees of Kotak Securities. If you do want to open an account with us, send us an email at invven@gmail.com. Thank you.